We all know that DCF is, I don't know all know or not, but I very strongly believe in this fact that DCF is the holy grail of valuation. Even though I don't uh, do DCF forecast because of my inability to forecast revenues accurately and to think about the discount rate to keep in mind. However, there is no debate on this that DCF is the best way. And recently we had a very good presentation by Soham on natural capsules, where he even shared his DCF model. But what we need to understand from these DCF models is that in DCF, two things play a very vital role. Number one is discount rate, the rate at which you will discount your cash flows. And number two is how fast your cash flows can grow in the future. Because whenever you're doing a DCF, you are basically taking future cash flows and then discounting it to present, right? Now, what happens in case of companies which may not have huge cash flows coming in or getting generated immediately, but have huge growth potential? You can see the last 10 years, specifically from 2010-11 to 2020-21. It was a period of free money all over the world, where money was available cheap to invest. And when money is available cheap to invest, and when there is low interest rate, in fact, places like US, the interest rate was closer to zero. You will tend to bet more on businesses where there is high growth available in the future, and there is a potential of those businesses earning a disproportionate amount of cash flows, say 3 years, 5 years down the line, compared to what they are producing today. However, in today's time, in 2023, when we are discussing this, the situation has completely reversed. We are now entering into a high interest rate scenario. So you have seen how tech businesses are now slowly getting adjusted in their valuation. And what do I mean by adjusted? Now that you know that the discount rate which you were using earlier were probably far lower, and in the current scenario, this should be a bit higher. I'm not giving you a number because I'm not very sure whether you should discount by 8% or 10%. There are academic reasons to take risk-free rate or add some premium to that. But I think from all practical purposes, it is very difficult to assign a particular number. But one thing which is very clear is the direction. The direction of discount rate was lower or closer to zero in the case of the advanced world, and very low in case of some countries like India. But that number is slowly directionally moving upward, right? So in this kind of scenario, you will find investors attracting more towards businesses which have immediate earnings flowing in, or even in case of high dividend yield companies. So you would have seen many people or many investors saying that just because dividend yield has been very high doesn't mean that you will invest in those companies. Yes, that was right in the last 10 years. But probably in the current scenario, you should probably look more into high dividend yield companies, because in the current state, the investor community will value them more than the future growth. Because today, an investor's mindset or a typical investor's mindset will be towards cash flows which are visible today or maybe at best next year. Though we don't want to take a 5-year view in the current macro environment. And that is where I believe the valuation of Delhivery today doesn't offer that much margin of safety today. And how I'll explain why I say that. Blue Dart, which has been a solid player, which is having 20 plus ROE for a long period of time, which is producing stable and growing cash flows over the long term. And even though the growth has been okayish, but the company of Blue Dart is now today available at around 14,000 crore market cap. Delhivery, which has burned cash for its growth over the last 10 years. Even today, when there is no clarity as to when can you expect profitability to come to this company, it is trading at somewhere around 24,000 crore market cap. You may argue that the sales of Delhivery and sales of Blue Dart are not the same, but you also look at the earnings. You also look at the cash flows. On both these areas, Blue Dart is way ahead than Delhivery. So Delhivery getting a market cap of more than Blue Dart today seems to me as a little bit on the higher side. Again, that it's not a sacrosanct. You should not wait for Delhivery's valuation to come down to Blue Dart or Blue Dart to go up to Delhivery. What I mean to say over here is that at the current stage of their business, I believe Delhivery has not reached to that stage of its life cycle where you can bet on it very clearly, or you have a very clear understanding of the path of the profitability. So because there are more uncertainties, there are more risks ascertained to the business, you should have a far more higher margin of safety. Now, some people will make a mistake of comparing price to sales of Delhivery with Blue Dart and also with other new age businesses. I will say don't do that. Why? Because as I mentioned in the previous slides, Blue Dart, the other new age businesses or the other platform, so-called platform businesses are actually non-linear business. For them, some of them, like say IEX, is already profitable, insanely profitable, having 60 plus operating margin, in fact 80% operating margin. And in case of companies like say RateGain Travel Tech or Car Trade Tech, which we have covered again in the past, they're also, even though they are not insanely profitable, we can see a clear path where whenever their growth, as they are growing their revenues, their profits are increasing at a disproportionate rate compared to the rate of the revenue, right? So since Delhivery is not, it doesn't fall in that category of business, so it would be foolish from our end to compare the price to sales multiple of those companies, or say even PE ratio of those companies, or price to book ratio of those companies, and then compare it to Delhivery. So every business has its own challenge. And now that we understand that Delhivery doesn't form part of those kind of businesses, you should be very careful as to what valuation you should pay.